Hi everyone. Today we're going to be doing the lecture for Chapter 12 for Accounting for Partnerships. And for this chapter, we only cover a few of the pages. We start with the beginning. Technically, the chapter starts on page 510, and then we are going to cover through page 517. So with this chapter, it's about accounting for partnerships. So we're going to be looking at in Accounting 1, we had done accounting for service companies or for sole proprietorships. So now we're going to be looking at if there's more than one owner, and that would be a partnership. So to start off, there are different things that you need to do to complete or to form a partnership. So that's what we're looking at first, the different characteristics. So our first one is going to be voluntary association. So when we're looking at that, we're looking at a partnership as it's people that are choosing to form a group together, even if there's no express agreement to form one. So they're choosing to become partners with each other to create a business or to organize their business. Typically, that business is going to require at least two. It can be more than two legally competent people who are agreeing to be partners. Through that, they form what's known as a partnership contract. Sometimes that's also called the Articles of Co-Partnership. Typically, we want that to be in writing, but sometimes it's not. Sometimes it can be just a verbal agreement. So when we look at that, there are different things that we want to see in that partnership agreement. There are 7 things we're looking for. So the first thing is the names and the contributions. So who is a partner? And then we want to know how much are they contributing or what types of assets they're contributing to that company. The next thing is going to be the rights and duties. So what have we agreed that each partner is going to have rights to do, or what are their duties to complete? Then we're looking at how are we going to share the income or losses of the company. That has to be determined ahead of time because we're not guaranteed to have that income. And sometimes it's easy to decide how to split income, but if you have a loss, not everyone's always in agreement. The next thing is the withdrawal arrangement. So what happens if someone says they don't want to be part of the partnership anymore? What is the process for them to withdraw from that partnership? Then we want to look at number 5, which is the disputes procedures. We want to see if there's a disagreement or if we don't all agree on how we want to do something in the business, how are we supposed to handle it? That's important to know ahead of time. We don't want to deal with something when we're in the midst of a dispute. We want to know ahead of time, how is that going to be handled? Then we want to look at the admission and withdrawal procedures. So once we've decided what type of withdrawal arrangement, like how it would be divided, we want to look at how that could be withdrawn, or what happens if we want to add new partners. So whether we want to add or remove partners, we want to have a process to be able to do that. Then the last thing we want to look at, how do we handle it if a partner dies? So what do we do? How do we look at the rights and the duties of that partner and how that works if they were to not be here anymore? So the next part we want to look at is taxation. When we look at the taxation for a company, we're thinking, a partnership is a company, so it's going to be taxed. But that's not necessarily true. The income or the losses of the partnership is actually allocated to each of the partners. And that's why it's important to have that detailed out in that partnership agreement of how are we going to share that income and loss, because it's taxed individually with each partner. The next thing we want to look at is limited life. So with a partnership, the life of the partnership is not unlimited. It's not going to go on forever. It can be dissolved, and that's the end of a partnership, and that's referred to as a dissolution. But the limited life means that the life of the actual partnership is limited. So if you have a death, bankruptcy, or if someone's not able to fulfill that contract, that can end a partnership. So any one partner can terminate a partnership at will, and that's set up in that partnership agreement also. The next thing is mutual agency. So mutual agency means that we're looking at each partner that is fully authorized to make decisions for that partnership. So as its agent, a partner can commit or bind that partnership to a contract within the parameters that are set up for that partnership business. So we're allowing them to make decisions and enter into contracts. So it's important to make sure that we agree on what kind of powers each partner has and make sure we limit anything that we do not want. All right, the next one is unlimited liability. So just like when we talked about with the sole proprietor, unlimited liability means that if the partnership were to have debts that someone had to pay, it doesn't matter who in the partnership created those debts, you're all equally responsible. So someone has to pay it. When we look at that unlimited liability, each partner can be required to pay the partnership's debts. So it depends on how you have it set up, and sometimes we look at different partnerships and we can see that with a general partnership, all partners have mutual agency and unlimited liability. But there can be limitations, and we'll talk about how the partnerships can be organized in just a minute with that. All right, the last thing we want to look at is co-ownership of property. So those partnership assets that are put in are jointly owned by all partners. So a partner may invest something in the business, but once they invest it, it becomes joint property of all of the partners. It's not just that one partner's. And each partner is going to have a claim on that asset from their capital account and in that partnership contract. All right, so let's look at the different organizations within partnership and the characteristics of each of them. So first we can have a limited partnership, and that's abbreviated with an LP. So with a limited partnership, those are people that want to invest in the partnership, but they don't want the risk of that unlimited liability. So instead, they form a limited partnership. So that's why it's identified with that LP, or sometimes you're going to see LTD, and it means the same thing. So a limited partnership is going to have two classes of partner. They're going to have general partners and then limited. At least one of the partners has to be a general partner, and they're the ones that are going to be responsible for those debts. They have the unlimited liability. But then you can have other limited partners that have no personal liability. So all they at risk is the amount that they're investing in that partnership. Then we can look at limited liability partnerships, or LLPs. So a LLP is where we are trying to protect innocent partners from like a malpractice or from negligence. So typically you're going to see those in like law firms or in medical fields, things like that. So we're going to abbreviate that with LLP. So what happens is it means that if one partner commits malpractice, the other partner is not liable for that claim. So only the partner that committed malpractice is actually going to be the one that's liable. Next, we can see that we have LLC companies, and that's the one we see that's the most common. So it's a limited liability company, and it's similar to like a limited liability corporation, and a lot of businesses do use this formation. So when we have this kind of business, they actually have members, and they're protected with that same limited liability as an owner of a corporation would be. So limited partners can actively participate in the management of that limited partnership, typically, but the members of a limited liability company can have an active management role. When we look at income taxes, the limited liability company is typically still treated as a partnership. All right, when we look at the comparison of the different business forms, we have proprietorship, partnership, LLP, LLC, the S Corp, and the corporation. So choosing the proper business form for a company is really important. You have to know what you're looking at. And this is just a quick summary to show you if the business entity is separate, if it's its own legal entity, if there is a limited liability, how the business is taxed. So if you look at that one, for example, we can see that only corporations are taxed as a business. All the other ones are taxed individually. And then whether it's just one owner or if it's multiple owners or if you can only have one. So that's just a kind of brief view of that one. All right, so how do we organize a partnership? That's what we're going to be looking at next. So the partners can invest assets and liabilities into that partnership. So it's important to know that we can do both. What happens with assets and liabilities is we're going to have an agreed upon value. Typically, it's whatever the fair market value is. So if your asset is, you might have paid $100,000 for it, but if it's only worth $50,000, $50,000 is going to be the value that's going into the business. You're not going to get to value it at $100,000 just because that's what you paid for it. If it's not worth that anymore, then you don't get to value it as that. Then same thing for liabilities. We're going to be looking at we could bring liabilities in. So you might have a note that you signed based on an asset you're bringing into the business. So you might bring an asset that has a value, but you've signed a liability that you still owe for. So that liability can be brought in too. And the net amount of them is what would be your contribution to that company. All right, so here's an example for organizing a partnership, and it says on 1/11, Kayla Zane and Hector Perez organized a partnership called Boards. Zane's initial investment is $7,000 cash, $33,000 in boarding facilities, and a note payable for $10,000 on the boarding facilities. Perez's initial investment is $10,000 cash. So we can see in this one we're doing a journal entry. So the partnership is getting cash and boarding facilities. So it says Zane's initial investment is $7,000 cash and $33,000 for boarding facilities. So we're recording the investment of Zane on January 11th by debiting cash and crediting boarding facilities. So that's a total of $40,000 that Zane is putting in. But Zane is also bringing the note payable for $10,000 that he still owes on those boarding facilities with him. So it just decreases his equity by that amount of liability. So he put $40,000 assets being cash and facilities into the business, but he has a liability of $10,000. So the equity he gets, or the capital, is going to be the difference of that $40,000 minus the $10,000. So a total of $30,000. So that's why we see the credit to capital being total of $30,000. Then for Perez just put in cash. So Perez put in $10,000 cash and that means he got $10,000 capital for his investment. All right, so when we have the partnership owners, and we have more than one, we are going to have separate capital accounts for each of the owners, and we're going to have separate withdrawal accounts for each of the owners. So each partner is going to have their name, comma, capital, their name, comma, withdrawal. So we're going to have an individual capital account and an individual withdrawal account for each of those partners. All right, so this video is going to stop here. The next video, we're going to go in and do some of the practice, and it has the need to know, which is in another video.